Embedded insurance offerings continue to broaden, providing insurers with a growing access point to digital first consumers. This new distribution has a strong growth trajectory that is being bolstered by technology gains and online consumerism. But there is some thought that embedded insurance may also eventually help bridge the protection gap by providing secondary coverages and ultimately building insurance awareness. We're joined today by AM Best Associate Director Eli Sanchez, who is heavily focused on Latin America's insurance markets. And Eli, can you take us through embedded insurance and explain how it's evolving and changing the relationship between insurers and consumers?
Hi, John. Sure. So, embedded insurance, it's a product that has been around for many years in the insurance industry worldwide. It's taking to take some impulse with recent new technologies and new ways of selling insurance. And in this way, embedded insurance can be defined as a product that it's done by an insurance company, but that it is distributed through non-insurance channels. So its characteristic is that it's frequently standardized and complementary to a product or service offered, and it has a limited insured amount or promises to replace a good. With limited insured amount, we mean that most of the times it's a low sum assured. Now, we believe that a well-developed embedded insurance product should aim to benefit the insurer, the distributor, which is not an insurance company, and the policyholder. Now, what we've been seeing in the market is with the changing economic conditions, meaning the impact of COVID, the impact in the supply chain, the influence of new generation mindsets, the advent of new technologies. Also, this has changed how the market perceives insurance and where they can get access to it and how they want to think of it. Now, we have also seen insurers noticing these ongoing consumer needs and trying to aim to focus those needs through other distribution channels. Now, there's non-insurers that also recognize that their product offering will benefit from the coverages provided from insurers. So we see the market asking for this kind of products, new generations influencing the way other generations think and the way they want to purchase insurance for their service, for their products, or for their needs they have. So it's an ongoing market that's growing. We have seen it more prevalent. Its prevalence in Latin America and in Asia, to some degree in Europe, but it's something that's taking some impulse in the US.
How do insurers and consumers stand to benefit from embedded insurance?
For the insurer, it provides opportunity to standardize limited coverages for a product or service and to be able to build a cost-effective distribution channel. Now, for the distributor, it provides an extra revenue source. It adds value to its commercial proposition, but the people from the distributor side have to be well trained in what they are selling. Otherwise, it could be a bad experience for the consumer. Now, for the consumer or the policyholders, then the coverage needs to be well regulated, secure, and offered through a simple commercial offer. So, in that way, they can be able to enforce the insurance in case they need it and to create loyalty to the insurer or to the distributor where they are acquiring it. So, there are opportunities for everyone. It can provide a way to develop markets in a cost efficient way, standardized coverages, build or reduce the insurance gap in certain socioeconomic segments. And in this way, it relates very interesting other aspects of microfinance and bank insurance.
Eli, what role does regulation play as embedded insurance continues to grow?
Well, it is fundamental. We have seen it's quite different across different regions and different markets in the world. There's not a standardized way of regulation. We have seen in some markets in Latin America where to be a distributor, you need to be recognized as such in the by the insurance regulator. Now, in other markets, you are also required to be registered, but you can also participate as a distributor in claims and also in premiums. So that puts a little bit more of risk appetite into the distributor without it being the insurer. Now it has to be well regulated, so all the coverages are really set to protect the consumer. So this is, I think, where regulators have to put an eye on, and it requires a commitment also of the insurance companies, and in some aspect a social component of the ESG equation in being able to educate the population and the segments where these insurance products are targeted.
So, Eli, what's the difference between embedded insurance and microinsurance?
Well, embedded refers mostly to a distribution channel outside the normal distribution channels that insurance companies does. Microinsurance is target to provide financial coverage or insurance coverage to the people that has more needs, economic needs, or are in a dire economic situation or are more vulnerable, uh, and to segments of the population or to specific economic areas that are vulnerable. So in this way, they are quite different. One is related to a distribution channel that can be target to any socioeconomical group. It's just tied to another product or to another service. And microinsurance can be either tied to something, but it's really aimed to help the people that have more economic needs, to provide them some limited coverages while helping them have some financial protection against any vulnerability they might have.
Thanks, Eli.
Thanks, John.
That's AM Best Associate Director Eli Sanchez. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.